Welcome to the Deep Dive, the show that goes deep into earnings calls to pull out the insights you need fast. Today, we're tackling AdaptHealth's Q2 2025 earnings. And this one, well, it was interesting. You had some initial financial headlines that maybe looked a bit soft. But then, set against that, there was this huge strategic announcement that really changed the conversation around the company. So let's unpack it all.
All right, let's start where we always do the numbers. So AdaptHealth reported Q2 2025 revenue of $800.4 million. That was actually down slightly year over year, about 0.7%. And it missed analyst estimates by a little bit. GAAP diluted EPS that came in at $0.10, and adjusted EPS was around $0.09. Both of those also missed expectations. So yeah, on the surface, maybe not the strongest picture initially.
Right, if you just glanced at those headlines, you might think, okay. But it's definitely not the whole story, because their adjusted EBITDA, that landed at $155.5 million. Really quite robust. And the margin was strong too, 19.4%. That actually beat consensus expectations. Hit the high end of their own guidance, in fact. And they generated a pretty healthy $73.3 million in free cash flow during the quarter, which again beat their own forecasts. So yeah, definitely a more nuanced picture than just those top-line misses suggest.
Okay, let's get into that nuance then, because while those revenue and EPS numbers might have given some people pause, the real story, the thing that got the market buzzing and the stock moving up, was this massive strategic win they announced, a new 5-year capitated agreement. Can you maybe just quickly explain what capitated really means in this context?
Sure. So basically, instead of getting paid for each individual service or piece of equipment they provide, under a capitated model, AdaptHealth gets a fixed payment per member, per month, let's say, from the health system. And that's regardless of how many services that specific member actually uses. It fundamentally changes the incentives. It shifts from just volume to managing the overall cost and health for that group of patients effectively.
So it aligns incentives much more closely with the health system, and the scale here is huge, right?
Oh, absolutely huge.
Yeah.
This agreement makes AdaptHealth the exclusive provider of home medical equipment. Think oxygen, CPAP machines, wheelchairs, supplies for a major national health system. We're talking over 10 million members covered across multiple states. That's a massive scale. And the projection, at least $200 million in new annual revenue once it's fully ramped up by the end of 2026, with margins, crucially, expected to be in line with their overall company margins.
Wow. Okay, so that's not just incremental business. That sounds like a fundamental shift.
It really is. It's a massive endorsement of their ability to handle complex patient needs at scale. It moves them towards that much more predictable recurring revenue stream.
Yeah.
Management's aiming for capitated revenue to be at least 10% of their total. It sort of validates their whole strategy of being a system-level partner, not just a transactional supplier.
Right. Becoming more embedded, more indispensable. But pulling off something this big, it doesn't happen overnight. What's the lift involved? What do they need to do to actually make this work?
Yeah, good question. It's a major operational undertaking. They were pretty clear about the infrastructure investment required. We're talking new, fully outfitted service locations, hundreds of new vehicles, and recruiting, hiring, and training over 1,000 new employees, drivers, technicians, support staff. So these investments are going to be ramping up between now and early 2026. And then the revenue from the contract starts flowing maybe 2 or 3 months after that. It's a big build out.
A serious upfront investment for that long-term gain. Okay, so while that huge project gets underway, how did the existing core businesses actually do in Q2? Let's start with sleep health.
Sleep health held up pretty well. Revenue was up slightly, 0.9%, hitting $334.7 million. And importantly, new setups, which is a key metric there, they actually accelerated. Around 128,000 new setups. That's their highest number in 2 years. So it suggests their operational improvements like standardizing scheduling and intake are paying off.
Okay, good to see the core holding steady. What about respiratory health?
Respiratory shows some really strong growth, actually. Net revenue up 5.6% to $170.5 million. They pointed to better sales incentives kicking in and also streamlining how orders come in, make it easier for doctors. And their oxygen patient census hit a new Q2 record, 329,000 patients. So yeah, that segment's performing quite strongly.
All right, now diabetes health. That one saw a revenue decline, right? Down 4.1% to $145.0 million. What's the story there? Still positive signs.
Yeah, despite that year-over-year decline, there were definitely some positive underlying trends. It was the third quarter in a row they saw sequential improvement in new patient starts. And their resupply retention was strong too. Management sounded pretty hopeful about returning to growth, maybe in the second half of this year. And their CGM, continuous glucose monitor, census also grew year over year again. So signs of stabilization, definitely.
Okay, some green shoots there perhaps. And the last one, wellness at home.
That segment saw a bigger decline, down 7.2% to $150.3 million. But that was largely expected, actually. It was mainly due to them selling off some non-core assets, specifically in incontinence and infusion supplies. It fits with their bigger picture strategy of simplifying the portfolio, focusing on the core areas like sleep and respiratory.
Right. That portfolio simplification makes sense, especially as they take on this massive new contract. And speaking of strategic moves, let's pivot to the balance sheet. How are they looking financially?
They've been really focused here, and it showed in Q2. They made significant progress on paying down debt, reduced the balance by $150 million in the quarter alone, mostly using the cash from selling those non-core assets we just mentioned. Year to date, they're down $175 million in debt. And if you look back over the last year and a half, 6 quarters, it's $345 million. Pretty substantial. Their net leverage ratio, that improved too, down to 2.81 times. They're getting closer to that target of 2.5 times. So definitely strengthening the financial foundation, which is crucial right now.
Okay, strong progress on deleveraging. So you'd think massive new contract, debt coming down, the full year guidance must be looking fantastic, right? Well, this is where it gets a little more complex and quite revealing about their priorities.
Exactly. It wasn't a straightforward guidance raise, which might surprise some people. They actually kept the midpoint of their revenue guidance the same, just tightened the range a bit, $3.18 billion to $3.26 billion. But, and this is the key part, they lowered their adjusted EBITDA guidance for the full year. The new range is $642 million to $682 million.
Lowered EBITDA guidance. Why? When they just landed this huge deal.
Right. Seems counterintuitive at first. But there are 2 main reasons they cited. First, the timing of some expected price increases from payers. Those negotiations have slipped into 2026 now. That's more than half the reduction. And second, they decided not to cut back on certain infrastructure expenses as they'd maybe planned earlier. Why? To support the build-out for that new capitated contract. So yes, it hits the 2025 EBITDA number, but it's very much an investment decision for future growth.
Okay, that makes sense. Investing now for the payoff later. But here's the really interesting bit. Despite lowering the EBITDA guidance, their free cash flow guidance for the year remained unchanged. Still $170 million to $190 million. How does that work? What's offsetting the lower EBITDA?
Yeah, this is a crucial detail and shows some smart financial management or maybe some helpful timing with legislation. Essentially, the significant spending on new patient equipment, the capital expenditure needed for that big contract, is expected to be at least offset by lower cash taxes. And that's thanks to a new tax bill, the OB-BBA bill that became law recently. A key part of it allows companies like AdaptHealth to immediately expense fixed assets, like all that new medical equipment they need to buy. So bigger upfront investment, yes, but significantly lower cash taxes right now, keeping that free cash flow guidance intact. Pretty important benefit for them.
That tax change is a significant tailwind then, especially given the timing of this contract. Okay, beyond the financials and the contract itself, management also talked about the bigger picture, right? Industry trends, regulations.
They did. If we sort of zoom out, CMS, the Centers for Medicare and Medicaid Services, put out a proposed rule in July about home health and DME competitive bidding. The details are still being worked out, but the general direction seems to be towards containing costs, maybe reducing the number of companies awarded contracts in bidding rounds. AdaptHealth's view is that their scale, their size and infrastructure actually puts them in a better position to handle this. They think they can potentially win a larger share of the remaining volume, even if there's overall pricing pressure.
So that potential regulatory pressure, the competitive bidding changes, it could actually end up strengthening the hand of the bigger players like AdaptHealth, almost accelerating consolidation.
That seems to be their strategic read on it, yes. It can make things tougher for smaller, less diversified providers. And that ties into what they said about M&A. They're seeing more opportunities come their way, more inbound interest. It feels like the pressure on smaller operators might be increasing, potentially leading to more consolidation.
Okay, so if opportunities are increasing, what's their appetite for deals? Are they going on a buying spree, given their focus on debt reduction?
Their message was very clear, extremely disciplined. That was the phrase they used. They'll focus M&A on their core areas, sleep and respiratory, maybe some geographic fill-ins where it makes sense, and only if there are real, meaningful synergies. Crucially, they emphasize they are not under pressure to do deals and will be patient and selective. And they absolutely will not increase their leverage for an acquisition. Any deal would need to be funded through free cash flow and actually help reduce leverage within the first year. So balance sheet strength remains paramount, even with potential M&A opportunities popping up.
Discipline seems to be a key word there. Okay, so looking ahead, what are the key things investors should be watching, the catalysts?
Definitely the milestones for onboarding that huge national capitated contract. How smoothly does that ramp up go? Checking in on the full year 2025 guidance checkpoints, especially given the moving parts with EBITDA and FCF, tracking their progress on getting leverage down towards that 2.5 times target, and of course, seeing if they can land any more large capitation or integrated delivery network deals that would further validate the strategy. And, the whole healthcare sector is kind of underperformed this year. So if AdaptHealth really executes well on this pivot, it could attract attention just from a relative value perspective.
All right, let's shift gears. This is the part of the show we call not financial advice. We put on our imaginary hedge fund analyst hats and throw out some, let's say, bold but perhaps plausible trade ideas. Strictly for discussion, purely educational. Remember, this is absolutely not investment advice. Investing has risks. Always talk to a qualified professional.
Okay, let's do it. For AdaptHealth, you've got a company that just landed this monster capitated deal. 10 million lives, huge. The market reaction was positive, right? Mostly shrugging off the slightly softer Q2 EPS once the implications of the deal sunk in. My take. This isn't just another contract, it's proof of concept. It validates your whole model of becoming a deep partner with health systems, not just selling equipment transaction by transaction. So trade idea one, I call it the capitation catalyst long play. The idea is a long position in AdaptHealth stock, maybe with some call options layered on top. Why? Because I think the market is still underappreciating the long-term value unlock here. This move to capitation changes the quality of their revenue, makes it more predictable, more recurring, and potentially higher margin down the road as they get really efficient at managing those patient populations under the fixed payments. Yes, there's that hit to 2025 EBITDA for the build-out, but that's a short-term cost for a massive long-term strategic win.
The call options, maybe looking out to mid or late 2026, could capture the upside if and when that new $200 million plus revenue stream really starts flowing and hitting the bottom line. Plus, you've got the deleveraging story and strong free cash flow as a bit of a cushion. This trade isn't about Q2, it's a bet on the whole business getting re-rated structurally.
Okay, a long play betting on the strategic shift really paying off over the next couple of years. What's trade idea two?
Trade idea two is the regulatory resilience pair trade. Given all that uncertainty around CMS competitive bidding, the idea here is a pair trade. Go long AdaptHealth and simultaneously short a smaller, maybe less diversified competitor in the DME space. Someone perhaps more exposed to potential price pressure in areas like CGM or general medical supplies bidding. AdaptHealth themselves said their scale helps them navigate this changing landscape. Smaller companies, they might really struggle. This could lead to AdaptHealth picking up market share or maybe even acquiring some of those struggling players on favorable terms later on. And don't forget those OB-BBA tax benefits helping AdaptHealth's cash flow that gives them more flexibility and resilience than smaller peers might have. So this trade tries to capitalize on AdaptHealth's relative strength in a potentially consolidating market while hedging out some of the overall sector risk. It's basically betting on the strong getting stronger.
Interesting pair trade idea, playing on that theme of scale and consolidation. Okay, let's wrap this up. AdaptHealth's Q2 2025 call. It really highlighted a major turning point for the company. Yes, there were some near-term financial misses, but that massive capitated agreement covering over 10 million people, that completely reset the narrative and sets them up for potentially transformative growth over the next few years.
Absolutely. Management seems very focused, disciplined on the balance sheet, driving efficiencies, and really leaning into this strategy of becoming embedded partners with large health systems. That positions them well for a potential re-rating by the market. The initial reaction was positive for sure, but now it all comes down to execution, delivering on that big contract ramp up and navigating any bumps in the regulatory road ahead. Those will be the keys to watch.
This has been The Deep Dive. Just a reminder, everything we've discussed is for informational and educational purposes only. It is definitely not financial advice. All investing involves risk, so please consult with a qualified financial professional before making any decisions. So, what are your key takeaways from AdaptHealth's big strategic move? It's worth thinking about how these kinds of shifts towards value-based care and system partnerships are reshaping the healthcare landscape.